Hey, welcome to this video. In our last videos, I showed along with examples, the importance of the income statement and balance sheet for a company. Today, we continue with the fundamentals of accounting. I'll talk about concepts of a third financial statement, the cash flow statement. Don't forget to share this video with a friend that's eager to learn as much as you. Are you ready? Let's go. The cash flow statement, also named as CFS, measures how well a company manages its cash position, meaning how well the company generates cash to pay its debt obligations and fund its operating expenses. This statement displays how the cash amount of company has evolved during the time period specified in the statement's headline. A company will be able to see how much money is generated and spent via its operating, investing, and financing activities. The balance sheet and income statement will provide much of the information for the cash flow statement. Here, an example of how a cash flow statement may look like. On the first rectangle, we have the operating activities. It's followed by the investing activities section, and at the bottom, there will be the financing activities section. The cash flows from operating activities section provides information on the cash flows from the company's operations. Company operations includes, between others, the buying and selling of goods and providing services. If we think on the most commonly used indirect method, the company's net income is the starting point of this section. From here, we'll need to make adjustments to change the amount of net income from the accrual method to the cash method. As mentioned in previous videos in more detail, let's shortly review the concepts mentioned on the previous sentence. 1. The accrual method versus the cash method. The accrual method shows that revenue and expenses are recognized and recorded when they occur, while cash basis accounting shows that the same line items aren't documented until cash exchanges hands. 2. The indirect method versus the direct method. The indirect method uses net income as a base and adds non-cash expenses like depreciation, deducts non-cash incomes like profit on sale of scraps, and net adjustments between current assets and liabilities to produce the overall cash flow statement. It's the preferred used method. The direct method of cash flow in operating activities includes the cash being received from the customers and the cash paid to the suppliers, employees, and others. The cash can also be paid for income tax, interest, and other variables. This method only uses cash transactions, and all non-cash transactions are ignored. Now, let's continue reviewing the sections of the cash flow statement. The cash flows from investing activities section shows the cash flows from the acquisition and sale of non-current assets, such investments in property, plant, and equipment. These are considered as long-term assets, which means investments that will benefit the company for more than 1 year. The cash flows from the financing activities section shows the net flows of cash that are used to fund the company and includes transactions involving debt, equity, and dividends. Let's now understand why the cash flow statement is required. We can summarize the main reasons why a cash flow statement is required as follows. 1. While the income statement figures generate headlines, they are based on the accrual basis of accounting, which, in turn, effectively assesses a company's revenues, expenses, and profitability during a short period of time. On the other hand, the income statement does not track or show the amount of cash flowing in and out of the business. For example, does not include the following information. Cash collected from sales. For example, a company might collect from customers several months after the sale. Cash paid from selling goods sold. As an example, a payment may have been made several months prior to their sale. Cash paid for buildings and equipment that will be expensed over several years. Cash received from the sale of long-term assets. Cash received from bank loans. Cash payments to reduce a loan's principal balance. Cash withdrawn by owners. And cash dividends paid to stockholders. Two, understanding a company's cash inflows and outflows is essential to fulfill short and long-term obligations to suppliers, employees, and lenders. 3. The cash flow statement is part of a financial analyst review, as they will mainly be looking at the operating activities section in order to see if the revenues, expenses, and net income reported on the income statement are consistent with the change in the company's cash balance. 4. In several financial models, the statement of cash flows provides the cash numbers required. Let me know, on the comment section below, if you know which are by now the 3 sections of the cash flow statement. In the next video, I'll be talking about the complete set of financial statements. I hope you can join me there. If you have enjoyed, want to keep on learning and still did not subscribe to the channel, you can do it today by clicking on the subscribe button below. Thanks for watching and I will see you again soon.